Premium Brand Holdings, the preparer of specialty foods, shrink-wrap sandwiches, etc., is buying a U.S. outfit called Stampede Culinary Partners for more than $660 million US in cash and stock. Let's get more on what the deal means for investors in premium brands. We're joined by Rebecca Teltscher, Portfolio Manager at New Haven Asset Management. Rebecca, great to see you. Happy Friday. And thanks for joining us.
Happy Friday.
What are you a shareholder in Premium Brands? Have you been following it for a while?
We are shareholders, and we actually just added more to the name a few weeks ago, and it was my top pick on BNN Market Call last week. I mean, they are doing all the right things, with regards to investing in the business. So, for the past few years, they've been quietly expanding their capacity to have more production in the United States. So if you think about it, they're pretty well established in Canada. Let's just say their largest customer, for example, a Costco, is saying, okay, great, we love your products in Canada. Can you bring them to the United States? We think they would do well. And Premium Brands, when it comes to capacity, going nationwide in the US is a different ball game than in Canada with regards to the number of stores Costco has. So they've been quietly building capacity. They've spent about $750 million on new capacity in the United States. And now that's pretty much done. So I think for the past few years, the stock really hasn't been going anywhere. Stock was pretty flat, because again, we're used to this, we invest heavily in pipelines. You put the capital up front and then you benefit from revenues that come later on. And that's exactly what Premium Brands has been doing. So now the capacity is pretty much complete. They're ready, and they just launched their first, nationwide meat stick, like their largest new product launch in history. It's a organic sugar-free meat stick. It's launched in the United States, will be coming to Canada soon. So they've been doing everything they said they've been doing, which is going really well. And then all of a sudden now, two days ago, they announced this acquisition. Again, it really fits their strategy. They have excess capacity in the United States. I'm talking about this Stampede business. So they're buying it for their capacity in the United States. They are nationwide. They have good relationships with, the Costco's, the Sam's Clubs, and they also offer a new, cooking facility, sous vide, which is new for Premium Brands. So, we think it's a good deal, and it's on the conservative side. They took advantage of a really strong stock price. They issued equity, and that's so they're not going to be taking on more debt. They're actually going to be reducing their debt because they're going to be using some of that equity to pay down some debt as well. So the stock is off right now because they issued equity at a pretty large discount. But we think they're at an inflection point with regards to their growth.
Right. So the stock actually up a little bit this morning, but did it fall yesterday, Rebecca, because of the word of the stock issue?
Yeah,
Okay.
so I mean the discount, the stock was trading at about 102 prior to the announcement of the equity issue. The equity issue price was 97.50, so pretty steep discount, and then it traded below that, which I'm not quite understanding why. But regardless, I mean, we are still very confident in the stock price over the longer term. It's very rare to find such a disciplined management team that's doing all the right things for such a long time. And they haven't really been getting credit for it in the market, but I think now we're starting to see that change. Like RBC upgraded them 2 quarters ago, and so we're starting to see them actually get credit with regards to everything they've been doing with regards to their capacity expansion and their disciplined approach. For example, when there hasn't been much for them to acquire over the past few years, they've been paying back a lot to that shareholders, been doing 10% a year dividend increases, which obviously as dividend investors we like to see. This year, now that they've been doing so much growth, they're not raising the dividend. They won't cut it, and they don't need to, but they have better places to deploy that capital into growth, acquiring these companies at very good multiples.
Yeah, maybe we could pop up a 10-year chart for Premium Brands because they fell early in the pandemic. I guess people were worried about retail sales or sales through gas stations and stuff. And then the stock went up through into 2021, then fell, but it sure has been rallying lately.
Yeah, so they do. So a lot of it is, they sell to Costco and grocery stores. They do have a percentage of their business that is, food service, so to restaurants, as well as convenience stores. They don't really have that much exposure to like the discounters. Like, their products are more, and they're called premium brands because they offer, premium products. So their customers really, you could find their products, for example, at Farm Boy locations, Trader Joe's, and also a lot through Starbucks and those clubhouses. So yes, it came off with the pandemic, just like almost every retail stock.
Yeah.
And then they came off earlier this year with regards to tariffs. But again, they had very little cross-border sales. They have their distributions in Canada. They have distribution now in the US. Very little cross-border trades. If anything, they were talking, and they, not that they want to advertise tariffs being good, because tariffs are not good, but they would actually benefit from a tariff situation because there was an opportunity to acquire businesses at a very low multiple, which would be good for their business. And they've been able, they said that the M&A environment right now is better than they've ever seen in their history. So again, lots of organic growth, lots of M&A growth. The capacity is built. So it's just a question of when they take on those sales. And we're seeing that firsthand with that first product launch that they did last month, and we're seeing that so far there's really good traction in that product.
The meat stick with no sugar in it that you referred to.
No sugar, organic, yeah. So none of, you would think, right, like meat stick, sugar, but you would be surprised there's pretty much sugar in everything.
Yeah. They have giant sandwich factories in Columbus, Ohio and Reno. And apparently they have up to 10% of the US market for packaged sandwiches. They dominate in America.
So again, one of the reasons the stock was off, I believe a year or two ago, was they do all the breakfast sandwiches for Starbucks in Canada. And so when Starbucks was closing stores and having, trouble, they got hit with that as well. But, we just met with management a few weeks ago, and they pretty much do all the prepared foods in almost every coffee shop in Canada. So if a Starbucks is closing and a new, coffee shop is opening, like what management explained to me was that maybe Starbucks stores are closing, but the actual number of coffee shops in general is still growing, as it's a growing industry, and they pretty much do all of that in Canada. There's an opportunity for them to enter the United States. They do, for example, the pastrami, I believe it's pastrami sandwiches in all the Costco's in the United States. So, you wouldn't think about it because premium brands, you think about it and you're like, I don't really know exactly what they do. I don't really know that brand, but that's a really good thing. They don't have, that brand risk. Let's just say like a Maple Leafs food does if something goes wrong. They operate very discreetly under, maybe 60 different banners, but they're everywhere. You just don't realize it.
Thank you so much, Rebecca. As a sandwich connoisseur, I could talk about this all day. Rebecca Teltscher of New Haven Asset Management.